Hi, everybody. Good evening and welcome to the Endowus webinars. Today's webinar is our usual quarterly update, 2Q 2022 Market Insights and Performance Review. I'm really happy to be here. It's been a while since we've done this webinar. For those of you who don't know me well, I am the Chairman and Chief Investment Officer at Endowus. And together with me, I'm really pleased to introduce Min Axthelm, who is our Director of Investment Research. Say hi,
Hi,
Min.
everyone. Nice to be here.
Great, wonderful. So we're going to get going, guys, with the disclaimer. And then obviously our usual Slido that most people would be familiar with, but the number is 345345. If you go below, you can probably click in the YouTube link or other social media. But if you put that in there, then you'll see where you can add questions. There is existing questions already. And if you like the questions and you would like that answered, then you can just put the thumb up and that will move to the top. And the most popular questions will obviously be answered probably faster. So Min and I will do a Q&A session at the end. So please use the Slido, and we'll have the numbers on the top of the slide. You see the 345345 at the top of the screen, so please refer to that. For many of you who have never, heard of Endowus or have not begun your journey with us, maybe a quick intro. So Endowus is here to help everyone invest better, to live easier today and better tomorrow. It really began because we ourselves found it very difficult and painful to invest our own money here in Singapore through the banks or traditional wealth managers. So we built a platform where individuals can access professional advice and institutional quality funds at the lowest cost, so that we have a better chance of success. So we are the only digital wealth platform to manage both private wealth and public pension because we're the first digital advisor to manage CPF investing. And as a result, we are the only platform where you can manage all of your source of funds and money, your cash savings, your CPF savings, and your SRS savings in a seamless experience on an app. We really espouse this fee-only wealth platform. So fee-only means that we're only paid by our clients. So we're always incentivized to do what's in the best interest of our clients, and not be paid by banks or distributors or fund managers or other partners or insurance companies. We've won numerous awards and we are backed by some of the biggest names in the industry, whether it's global venture firms like Lightspeed and SoftBank, but also the biggest private bank in the world, UBS, is our shareholder. Their first investment in any fintech or wealth company in Asia Pacific is in Endowus. But also we're very proud to be Singapore homegrown and headquartered. And we have economic development boards, global venture arm, EDBI, as a shareholder, as well as Singtel, among many others. We are the top-rated digital investment platform here in Singapore, whether it's the iOS or Google Play Store or the comparison site Seedly. We are the leading wealth advisory platform and the largest here in Singapore now. Our clients choose us for our independence and our fee-only service. We are holistic in nature, which can manage all of your assets, and we're always aligned to the best interests of our clients. But really, the three pillars of success that we believe matter the most is advice, access, and cost. So we deliver that in a great experience on a digital platform. But we have our client advisors licensed by the MAS available to you. So at any point in time, please reach out. You can have book a 15-minute session with them, or you can reach out to them by phone, email, WhatsApp, Facebook Messenger, numerous channels. And they're here to give you advice, help you with the onboarding, anything related to client services. We are very proud to be partnered with more than 70 fund managers, some of the leading world fund managers, and they manage tens of trillions of assets, all the familiar names that you have. And this is because we're agnostic. We're not trying to develop an algorithm that's going to beat the market and fail. We are developing a platform where you can manage all of your assets, access some of the best fund managers and their best products. And we help you get there by, screening and doing a lot of research. So Min heads up the investment research team together with Sean, who's the head of investment, Sean Wong. But we have a 10-people team who really engage the fund managers, do proper fund manager and fund due diligence, onboard only the best-in-class funds on our FundSmart platform. So we really screen and do all the hard work so that you don't have to have too much choice. But apart from the FundSmart platform, we obviously have custom-built portfolios, advised portfolios. The ones that many of you, if you're existing clients, will be familiar are the core products like flagship portfolios or ESG factor portfolios by Dimensional, and our income portfolios and satellite portfolios, etc. So we have numerous products that cater to each individual's needs across CPF, SRS, and cash. And we'll go into details of the performance as we update. But one quick plug on the FundSmart platform. The FundSmart platform is the cheapest way to buy any unit trust or mutual fund. We just introduced a series of Amundi passive index funds into cash and SRS, and we hope to bring that to CPF very soon, where the US Prime Fund, for example, is only 5 basis points, 0.05% in fees. It's the cheapest fund that has ever existed in Singapore. It's cheaper than ETFs here in Singapore, cheaper than any ETF in the usage range in Europe. It's the cheapest of any unit trust ever in Singapore, and it represents the US market, similar to a S&P 500 index. And it is the lowest cost way to do it. We've just today introduced it into our flagship portfolios for new customers, and we'll be doing a recommended portfolio change in the coming weeks. But you can buy that as a single fund or any fund best in class on the FundSmart platform at the lowest cost. So we're cheaper than iFast, Fund Supermart, or DollarDex, or Poems, or any of the brokers, much cheaper than banks for sure. So buy your unit trust on the Endowus platform. We're also very missional about the financial education and literacy piece. We have more than 900,000 total page views in our Endowus Insights write-ups. But we also have our live webinars where we do things like this, update you on portfolios and markets and macro. We partner with fund managers to introduce you wonderful content. So a quick plug to Min doing an ESG session next week with some of our fund manager partners, which I'll share with you later. But a lot of great content historically that you can use. And another quick plug for our annual inaugural Endowus Wealth Tech Conference. As a leader in Asia in the wealth tech space, we have launched a wealth tech conference where we'll have 5-6 panels, amazing speakers, and completely free especially for our clients. So please go to our website, endowus.com/wealth tech conference, and sign up and register. It's on the 12th of September in the afternoon, and it will be virtual and it will be free. So please sign up at any time. With that, I'm going to hand over to Min to go through a review of the markets, and then we'll review our Endowus portfolios, and then we'll also provide some market outlook and some macro updates as well before we end the evening with some Q&A. So Min, over to you.
Thank you, Sam. Hi, everyone. Thank you for joining us today for the second quarter update. I'm excited to be here. On this slide, the second quarter, as you can see, was another challenging period for most of the asset classes. They all ended up in negative territory with the exception of the yellow line, which represents the Bloomberg Commodity Index. So commodities was the only asset class with positive year to date. Even that too was negative in second quarter, but with the large returns that it generated in the first quarter, it was able to push out to a positive return year to date. However, it is important to note that while the returns for commodities look attractive now, there is a lot of underlying volatility that you're not seeing. And this is something that we'll talk about more in the next few slides. So that's just something to note. And also another thing to note is that the Bloomberg Commodity Index has about a third in energy. And with the energy prices that they are right now, that's been a major driver for excess returns for this index. Next slide, please, Sam. Thank you. This chart is a scatter plot of equity versus fixed income on a calendar year basis. So anything on the top right-hand quadrant shows years in which both the asset classes have produced positive returns, and anything on the bottom left-hand corner is where both the asset classes have generated negative returns. So as of year to date, 2022 is starting to seem like another one of those years. So one of only three. There's only been 3 years in which we've had both negative returns for fixed income and equities, and those were 2015, 2018, and now it looks like it might be 2022. We don't know whether the year would end up with negative returns for both, but that's what it looks like after the first half of the year. Next slide, please. Focusing on equities, we examined the value and growth spread. So value stocks continue to outperform growth stocks, helped by the fact that energy stocks are actually classified as value stocks. So we've seen that energy stocks have done really well. And so that has really helped to push up the value segment of the index as well. And looking at this chart further, you can see from the first line and the second line, which represents the end of Q1 and Q2, the spread between the two, value and growth, it has grown from about 8.8% at the end of Q1 to 16.1% at the end of Q2. So that's quite a change. I mean, and at the end of Q1, value stocks were largely flat, but even they were not spared from the sell-off in Q2. Next slide, please, Sam. Thank you. And drilling down further into equities, we now explore the sectors and how they have done. All the sectors are down year to date. Actually, all were down, except for energy, second quarter as well. So year to date, the only positive sector is energy. And while that looks attractive, we've already talked about how energy has been a driver for commodities. We look at the 3 and 5 year return, and you can see that the energy returns have not been as impressive. So that's something to bear in mind. Whenever an asset class looks attractive in the short term, it does not mean that in the long term, that's something that you want to be invested in. Next slide, please. So this chart, we now move on to fixed income. And this is to help us put into context what the scale of this year's drop down for fixed income has been. This chart shows some of the worst returns the fixed income markets have seen. And we thought, when you look at this, that's going to be the second one, the GFC, we thought that was bad, but there was nothing compared to what we're seeing now. With declines almost twice as much as what we saw during the GFC. And this is coming on the backs of rapid rate hikes from central banks around the world. Next slide, please. This chart shows that not only have we experienced the worst drawdown in many decades, we are also seeing the worst start to the year for the fixed income markets. So what we're seeing and experiencing in terms of the returns in our portfolios is not typical, but it doesn't mean that it's something to fear. The other thing to note here is that the fixed income markets have declined rapidly since the start of the year. But when interest rates start to decline, we should start to see the market turn around again fairly quickly. So that's likely what happened in 1980, which is the green line that you see here. Started to decline, but then it rose rapidly. So, if that's what happens, we could start to see something similar as well. But again, we don't know what's going to happen. Next slide, please, Sam. So this shows that despite what has happened in the commodities market, you can see that looking at the longer term performance, which over the 20 years is what we've seen here, the commodities have generated about a 5.4% annualized return with a volatility that is almost 4 times larger. So that's what you can see. And the early part of this chart for the red line, the maroon line, includes the commodities super cycle as well. And again, there's a sharp drop in 2008 when the super cycle ended, and we've seen a lot of volatility. So this is an asset class that is very cyclical, volatile, and is not something that you want to play around with. So it's something that we need to be careful around and to really examine what the longer term returns look like versus what it looks like now. Next slide, please, Sam. When we look at real assets, we see that there has been divergent performance between commodities. We've already talked extensively about them, and say REITs. So REITs have been popular with investors because they see it as a way to invest in the real estate market. In actuality, they are listed equities with underlying investments in real estate. So there's going to be beta with the equity markets. And so it is not surprising that the performance has been similar to that of the equity markets year to date. So they haven't really been the perfect hedge to inflation or to the markets. Next slide, please, Sam. This is a heat map of the equity markets. For the second quarter, one of the best performing major market was China, as represented by the MSCI China index. It is the only one in this chart with a positive return, and this is largely due to the uptick in June when the lockdowns were relaxed. The US market, as represented by the S&P 500, was the worst performer, which is a change from the first quarter where it was the second best performing market after Japan. Year to date, the S&P 500 has declined by nearly 20%. And this is on the backs of recession fears and sharp interest rate hikes by the Fed. And next slide, please, Sam. Now diving into the fixed income sub-asset classes, we see that the best performing fixed income asset class was the US Treasury market in the second quarter. In a reversal from Q1, the worst performing asset class was the global inflation-linked bonds. So this is a surprise to many, but inflation-linked bonds can be longer dated too, with longer duration, which means that they have sensitivity to interest rates as well, and so there is interest rate risk. And while they may have mitigated some of the inflation impact, they did not escape from the interest rate hikes. So that's why there was the performance was negative for global inflation-linked bonds. Sorry, excuse me. Next slide, please, Sam. So this, we can see that the yellow line, which was the end of last year, there's a gentle slope upwards. So that's how normal interest rate yield curves look like. But then as of June, you can see that there has been a steepening in the short end of the curve and a flattening and further down longer duration. And as of 27th of July, there has been an inversion, which means that the shorter end actually has higher interest rate versus higher yield, versus the longer duration bond. So the 2-year versus the 10-year, and that's that's what they call the inversion in the yield curve. And an inversion in the U.S. yield curve is sometimes an indicator. A lot of people take it as an indicator of a recession to come. It has been shown to be accurate many times, but it's not 100%. So we shall see. I'm sure Sam will talk about it further in his market outlook on what that means. Over to you, Sam.
Okay, thank you, Min. And I have to say, Min's recovering from COVID and braving this webinar, so doing a fantastic job. So thank you, Min. And we're gonna go directly into the portfolios and the performance returns. We're gonna start with the flagship portfolio as we always do, but obviously flagship has different portfolios for cash and SRS. Versus the CPF portfolio because of the constraints that the CPF portfolio has in terms of the availability of funds. Obviously, we're trying to narrow that. We brought some passive index funds, Amundi's products as it goes into CPF very shortly. within the next few months, hopefully we'll be able to introduce more. And also, maybe by the end of the year, dimensional products as well, and other wonderful funds that will go into CPF that will allow the portfolio to be more robust. As a result, the the flagship cash and SRS portfolios in the second quarter alone, the 100% equity portfolio obviously continued to outperform. So it outperformed in Q1, and it again outperformed in Q2 versus the MSCI All Country World Index. Still a painful negative number, and many of our employees are also investors in this flagship portfolio. So it's painful for all of us, but that's what markets do. And as you know, the equities portion has a passive component to it. And then we also have dimensional funds with factor exposure, which exposes ourselves to the long-term proven factors of returns like value and small and quality. And value and quality in particular have outperformed, holding up the portfolio. Unfortunately, the flagship portfolio also has a fixed income portfolio that is a bit more active, and therefore it's underperformed the global ag index, the benchmark, which has a much, much higher portion of global government bonds, especially the US Treasuries, which have, as Min showed in the kilt chart, did relatively well versus the corporate, bond market, which has suffered more. And as the flagship portfolio has a greater reliance on the corporate bond market, and that's what drove the outperformance in 2019, 20, and 21. But 2022, this first half has been, painful, just as it was in 2020. So it is a downturn, and it is higher beta. And the flagship portfolio, the CPF portfolio, which I'll go to first, again, for the 100% equity portfolio, after underperforming in the first quarter, has outperformed quite meaningfully in the second quarter. But also the bond portfolio, which obviously with the constraints have a shorter duration and a higher government and treasuries exposure, outperformed the global ag index quite meaningfully within a bond context in Q1 and again in Q2, making up for the underperformance last year. So if you put money into CPF fixed income portfolios this year, you would have done very well. Also going to the factors portfolio, which we launched together with Dimensional, 100% dimensional only factor portfolios. So exposing yourself to the proven factors of returns. And the equities portfolio, again, very similar to the flagship, but did even better than that by outperforming the benchmark MSCI index. But the bond portfolio, similar to the flagship, underperformed the global ag because of its higher exposure to the corporate sector. Now, the ESG portfolio obviously is a high beta, high growth kind of portfolio. So we know that technology and other growth sectors have meaningfully underperformed year to date after performing really well last year, and since the COVID crisis began. So it outperformed in 2019, 2021, 2020, and on a 3-year basis has a large outperformance. But in 2020, it underperformed because of the growth and sector biases that ESG portfolios have. However, if you look at the MSCI ACWI Growth Index, which is a second index in the global market indices table at the second half of the table at the bottom, the MSCI All Country World Index Growth Index versus value underperformed massively and was down 18%. So, and again, in first quarter, it was minus 9.3%. Whereas in 2021, it was at 19.4%. So the ESG portfolio actually did better if you look at it compared to the growth index. With that, I'm going to hand over to Min to talk about the other income and satellite portfolios.
Thank you, Sam. For the income portfolios for second quarter, we'll start with the stable income portfolio first. The stable income portfolio has 100% fixed income, so therefore it's benchmarked to the Bloomberg Global Aggregate Index. The stable income portfolio underperformed. Thank you, Sam, because it has actually more credit exposure relative to the index. So this is a common theme for all the three income portfolios. The underlying funds that they're allocated to have quite a healthy exposure to high yield credit. And as we saw in the quilt, high yield credit has actually underperformed investment grade. So that has been a major detractor for all three portfolios. So similar story for higher income, similar story for future income, because they have 80% fixed income and 60% fixed income as well. So the next slide, please, Sam. The most important thing here, though, is that the income portfolios are designed to generate income, and they are meeting our expectations in terms of performance, but they're also meeting their payout targets, as you can see. And they've even, like, the income has actually risen because of the rising yield a little bit. So they are meeting their targets. Next slide, please. Sam, thank you. So we'll go over the rest of the satellite portfolios pretty quickly in the interest of time. The first one is the China equity portfolio. It outperformed the MSCI Golden Dragon Index. The major part of that outperformance is actually due to the fact that China equity portfolio has much higher portion in China A shares versus the index. And the China A share securities have actually done better than the offshore China securities. So therefore, that has been a major driver of excess return. The second one is the global real estate portfolio. It underperformed the benchmark. And the main driver of that is actually one of the underlying funds that the portfolio is allocated to has quite a big exposure to industrial REITs, and industrial REITs actually underperform some of the other segments. So that really hurt performance. For megatrends underperformed as well, but as you know, megatrends is tend to be more concentrated. The portfolio tends to be more concentrated in terms of growth securities. So there is definitely an element of that growth value at play. So the growth tilt has actually really hurt megatrends portfolio in Q2. Technology here, there are two main reasons for technology underperforming. The first is the small cap exposure. The technology portfolio has quite a bit in small caps, and small caps have underperformed large caps in Q2. And the second is the extreme growth tilt that technology portfolio has versus the index, which is more of a broad index. The two fixed income portfolios, China fixed income, it underperformed. Well, there's actually no benchmark here because it's hard. The China fixed income portfolio that we have has both onshore and offshore. It's hard to find an index that actually has a good fit with that portfolio. So therefore, we don't really have a proper benchmark yet. It has a negative return because one of the underlying funds has exposure to the real estate market, real estate bonds in the China market. So that's been, as you know, been a very challenged area, and therefore that has detracted from performance. The low vol fixed income did better relative to the credit index, but underperformed slightly relative to the credit 1 to 5 year index. And that's really due to the allocation to higher credit again, which we've already talked about. Next slide, please, Sam. And I'm going to pass over to Sam to discuss the cash smart portfolios.
Yep, thank you, Min. So for the cash smart solutions, which is obviously a way to manage your short to medium treasuries and cash management, where you do not want to deploy to the market and take meaningful risk. So cash smart secure is a very ultra short duration exposure to mostly institutional bank deposits and also money market funds and enhanced liquidity products. The enhanced product has slightly longer duration of almost a year compared to the 4 months of cash Smart Secure, and takes a little bit of exposure to short duration bonds, but not that much. And then Cash Smart Ultra, while it does have an anchor position in money market funds, it is largely a short duration bond fund with duration extending, and this can fluctuate between 1.5 years and 2 years. And so the three products are completely different products, even though they share a common name of Cash Smart. It's really about the individual's needs, the duration in which they want to invest, and also the level of risk they're willing to take. So if you are risk averse, then obviously you will only pick Cash Smart Secure, because Cash Smart Secure, as you can see in this performance slide, has never lost money. So there is a possibility you can lose money, but it's very, very, very rare. Even in 2022, we've had rarely a day of losses. And therefore, you can put your money safely and expect that to generate returns of 0.7 to 0.9%, close to 1%. Enhanced obviously has a higher target, but is taking more risk, and therefore with duration as well. So, when interest rates rise, duration directly negatively correlates. So if you have a duration of 1 year, interest rates rise by 1%, then you lose. So the portfolio, the product should be down 1%. That's what duration is. So interest rates go up by 3%, then it should be minus 3%. Nothing has changed. Default risk hasn't changed. The interest rate of the underlying bonds haven't changed. But what happens there is that you can reinvest, all the maturing bonds at a high interest rate because interest rates have gone up. So I'm gonna, go into a bit more detail on this, because Cash Smart Secure obviously generated a positive return, higher than the first quarter. So Cash Smart Secure was great. Enhanced finally generated a positive return in Q2 after negative return for a few quarters. Cash Smart Ultra continued to generate a negative return, but less than before. And we know that since the past week or so, when interest rates actually started coming down in the US, it's finally generated some positive returns for Cash Smart Ultra. So we hope that the trend will continue, but we'll see. Interest rates is the overriding impact generated in terms of returns. And, this is across the board. So Cash Smart Secure, the blue line, has been very stable, generating steady returns, never generating a negative return. Cash Smart Enhanced obviously fell from the end of last year coming into this year, but it bottomed in, I think March, June, April period, went up and then came back down a little bit in June, and then has since started going back up again. So Cash Smart Enhanced has trended much better. But Cash Smart Ultra is the one that has fallen quite a bit from the peak. But I would like to point out that, what the other benchmark indexes like the Market iBoxx Singapore Government Bond Index and the Bloomberg US Treasury Bond Index has done. These are supposed to be the safest bond indexes, and they've significantly underperformed the market as well. And Cash Smart portfolios are not built on the Endowus platform in isolation. It's built as a series of products that is across a spectrum of risk, across a spectrum of duration. It's across a spectrum of products that investors should be using depending on their personal needs. So as I said, Cash Smart Secure is for the lowest risk, generating the lowest yield, but it's safe and steady and generates good yield for surplus cash that you don't need. But then Cash Smart Enhanced and Ultra, and then beyond that is low volatility fixed income, which is higher duration and a little bit more risk, but is safer than 100% fixed income portfolio, which is completely exposed to duration and fixed income market. So you can see clearly exactly what happens in a market decline or in a market rebound. The risk profile of the 5 different portfolios are doing exactly what they should. So they are going up more, the more the risk and volatility and duration risk exist. And then when it comes off, then it's commensurate to the risk you have, you lose more money. But Cashmart Secure, it was built to protect capital, and therefore doesn't matter whether there's a market decline or a rebound. Every single period is a positive number. So the one product, Cashmart Secure, is supposed to not lose money, but everything else is supposed to give you better returns on the way up and give you worse returns on the way down, the more you take risk. So this is a perfectly correlated product. We designed it that way. It's doing exactly what we expected it to do. Now, we need to understand clients and guide clients and advise them to pick the right one that is most suitable to them. But we have to also understand the unique, unprecedented nature of what has happened recently. So if you look at the market decline, the last bar chart, and how much fixed income markets have come down, how much low volatility fixed income has gone down by double digits now. It is a result of China COVID policies, the U.S. interest rate hikes, the global emerging market, weakness, but really Ukraine and the food and energy crisis and inflationary shock has exacerbated that. So nobody could have predicted any of these things to happen. And as a result, you can see that fixed income markets have done terribly. And Cashmart Ultra is something that you would use like surplus cash or something to be more protected so that you can deploy that money back into the market when the market is the appropriate time, into fixed income or into equities, which has fallen even more. Normally goes up more and falls more. So we didn't add the equities index, but if you put equities, it would be going down more and going up more as well. So I think the most important thing people need to understand is what Cashmart Ultra, what Cashmart Enhanced, Cashmart Secure is supposed to be, and how is it placed within the context of low volatility fixed income and 100 fixed income and even equities. And so as an investment platform, you are moving money around depending on what your needs are, and then you should be deploying the Cashmart Ultra into higher return products over time. And for fixed income specifically, the good thing about rising interest rate, the negative thing about rising interest rates is obviously that immediately there's a mark-to-market, what's called a mark-to-market impact. So as I said, if duration is, let's say 5 or 1, then interest rates rise by 1, then interest rates and duration match and you have a minus 1% return. If duration is 5 years and interest rates rise by 1, then you're minus 5%. So that's what's happened. Interest rates go up 3% and your duration is 5, you're minus 15%. So there's an immediate impact on the pricing of bonds, despite anything else changing because of interest rates changes. But what happens is that, a bond fund, which is an amalgamation of many different bonds that you own, there has a constant level of maturing bonds that is going to come back to you. Once that bond comes back, you're able to reinvest that as a portfolio into the fixed income market. And in a rising interest rate environment, you're going to be able to invest in higher yield. So the longer you hold this portfolio, especially for fixed income, you're able to generate higher yield and eventually higher return. So that's what's happening also to the Cashmart range, that whether it's Ultra or Enhanced or Secure, what's happening is that a lot of the new bonds that are being invested into are going to be priced at 3% plus for Ultra, and it's going to be 2% plus for Enhanced, and it's going to be 1.5% and above for Secure. So expect these yield numbers or projected yield numbers to continue to rise. But it has to be taken into account together with the duration, because the duration of 4 months means that within 4 to 6 months, the whole portfolio will change and you'll be able to invest in the 1.5% for Secure. The enhanced duration is 1 year, so you have to wait a full year before the whole Cashmart Enhanced is recycled into high interest rates of 2+%. And Cashmart Ultra has a duration of 1.7 years, so you need about 1.7 to 2 years for the whole portfolio to recycle into a higher interest rate product. And the one positive that can happen is if interest rates, because of recessionary fears, come down, then that immediately will give you positive returns whether it's cash smart, enhanced, ultra, or secure. So that's the dynamics of the projected yields, why it's rising despite the negative returns we've seen. That's a common question that we receive. These are mutually exclusive things that move in opposite directions. And there's a question in Slido. The top question right now is about cash smart enhanced. When you see cash smart balanced, I think the client or the questioner was saying enhanced, but cash smart enhanced and ultra become positive again. So it depends when you invested, because everybody invested at a different point in the cycle. Some people who invested really early when we launched may still be positive. There are going to be people who recently invested, may have enjoyed the bounce and enhanced, will be positive. But if you had been investing for longer in between, then obviously you would be negative. And so it depends on the individual. The direction of the portfolio turning positive is good for enhanced. And we hope that ultra, we're doing a review and we'll publish a more detailed insights article on this. The fund managers that we have spoken to have given us some positive feedback, and hopefully if interest rates peak and start coming down, then ultra will start outperforming quite meaningfully. But it's too soon to say, and so we'll continue to update you if you're an existing client through a separate update on cash smart products, because we blended that into our monthly update, and we'll hold a separate webinar where we'll field the questions from clients and new prospective clients who have questions about cash smart. I will personally be there. Maybe Min or Sean or whoever is available will be there to answer any questions. So we'll have a separate webinar on cash smart, and I've spent enough time today, so we'll move on to the other portfolios and the second half outlook. Okay, so maybe we can see Slido, Min, while I present on the market outlook, and see if there's any that we should highlight or respond to. And please shout out if if you want to bring that into the discussion in the market outlook. So the way to look at this chart is the market's expectations of what the Fed will do in the next rate hike in July. So remember, we've had multiple meetings, multiple hikes. July is the next one. It's actually overnight tonight. So we had to choose the day where the Fed will be announcing overnight. But we know what will most likely happen, which is Jerome Powell, the Fed chair, has guided us to a 75 basis point hike. July 14th, you can see that the 50 to 75 basis point hike suddenly had some expectations, more than 50% expectation of a 100 basis point hike on July the 13th or 14th, because on that day the latest inflation number was printed, and it was a 20-year high of 9.1%. And therefore the market freaked out and said, oh, maybe the Fed should be increasing by 100 basis points instead of 75. Since then, that expectation has subsided. We know that last month is probably going to be the peak of the inflation print, and may start coming down a little bit because of fuel costs coming down and other factors and year-on-year comparisons. So most likely the Fed will increase rates by 75 basis points overnight, and we won't be surprised. I think that's a good thing, because up to now, one of the major concerns in the market was the fact that there was a heightened level of uncertainty about where inflation will peak, what the Fed will do, and the Fed, was chasing their own tail and was behind the curve. But I think they've come to a place where there's much more clarity and visibility, and therefore less uncertainty, and that reduces volatility in markets, which is positive. Now, the Fed has 2 more rate hikes in September and November. So September, November, 2 hikes, and the market's current expectation is for another 50 basis points, potentially 75, but I think the consensus is now 50, 0.5% for both. And if they increase that, then obviously the rate will be, after tonight, it will be 2.25 to 2.5% range. And then an additional 1% on top of that is 3.25 to 3.5%. And therefore, the peak of the interest rate hike for the Fed will be over by the end of the year, and the beginning of the year will see us at 3% plus Fed fund rate. So this is the number that we've seen. the Fed increasing the interest. Sorry, I should have moved to the slides forward. And I put a blue dot onto where the Fed fund rates will be overnight by tomorrow, and where the 2-year and 10-year, as Min highlighted, there's an inversion, but the 2-year, 10-year numbers are, and obviously we've seen market interest rates move way ahead of the Fed, and now has started to come down because of the recession concerns, and that the Fed will tame inflation. And with that correction in the yield, we have seen a rebound in bond prices and bond performance. Where will the Fed end the year? As I mentioned, I think that this is a very complicated chart, but basically the red is below 2%, the orange yellowy is below 3%, and the purple is above 3%. And clearly, this is just this year, how dramatically expectations have changed. So that, from June, all expectations are that by the end of the year, we'll be above 3%. And that's where we'll finish. And that is because of the sustained level of inflation that we've seen in the US. Now, all the question in markets is really, when is the US headed for a recession? Now,
Sam,
yes.
sorry, there's a question on Slido about whether an investor should hold off buying fixed income funds if the Fed is expected to increase interest rates.
Yeah, so that's a great question. And maybe I'll go back to the slide before. So when we say we'll hold off on fixed income funds because Fed is expected to increase rates, the question underlying it is, the assumption is that as you raise interest rates, bond prices will fall. But what drives bond prices and fixed income fund performance is not the Fed fund rate, but the market yield. So you see here the 10-year and the 2-year market interest rate already price in a level that is much higher than what the Fed actual fund rate is. So this is why we say the Fed fund is always behind the curve, and the market is always pricing in the realities of the macroeconomic condition, the Fed's expected Fed rate hike cycle, and the timing of that to always be ahead of the Fed. And so this market yield increase, which affects not just government bonds, which is Fed fund rates at the short end, but also corporate bonds, muni bonds, and global emerging market bonds, etc. It affects the whole spectrum of fixed income markets, and therefore the market yield is what's the most important thing. So the market yield spiked up and pulled back a little bit in May and into June. And so people said, okay, maybe the fixed income's worst is over. And then it suddenly spiked up with high inflation and the Fed raising interest rates by 75 basis points. But again, from there, you're starting to see that come off. So unless you think that the Fed interest rates are going to significantly be above this 3.5% expectation or the 3% expectation, the market interest rate is probably going to be stabilizing at this level between 3 and 3.5%. And if I was going to go on to the recession discussion, but if there is a recession and demand slows down, and as a result, inflation comes down, then the Fed will have some leeway to cut interest rates again. And the market will start pricing that in earlier than what the Fed will do. And that will drive bond prices higher and bond performance higher. And therefore, probably the timing to sell fixed income funds is probably behind us. Is it time to buy again aggressively? We don't know. It depends on the direction of the interest rates. But from here, I think a lot of the risk is already priced in. A lot of the losses have been realized, and therefore it's more likely that we should be looking at opportunity to buy rather than to sell, especially the Fed's interest rate high cycle becoming much more visible. On recession, there is a technical aspect of the US market where in the first quarter, because of the fiscal spending being a drag, and because of technical factors like inventory, there was a negative growth in the first quarter in the US. Now, there is a possibility that we may see a small negative growth in GDP in the second quarter as well. It may not happen. It's 50-50. It may be slightly positive or slightly negative. It's almost a break even. And if it prints a negative GDP, then people will say, oh, it's a recession because we've had 2 consecutive quarters of negative growth. Unfortunately, that is a technical recession as we normally commonly define it in the markets. But in the US, it's actually the Economic Review Board that determines whether there is a recession or not. And in this case, it's highly unlikely that they will announce that that is a recession. And more likely, the concern should not be about first quarter or second quarter. It should really be about the second half into next year. So there is a rising expectation in the market, whether we look at forward-looking indicators in financial markets, whether it's the economic indicators that many people track to look at the probability of recession coming. We think that it's still below 50% in terms of the probability of recession. Official recession, not technical recession. And many people think that we may see another negative print in the fourth quarter or first quarter of next year, but it's probably unlikely to be a recession because we're still recovering from post-COVID demand. There's a lot of strong demand for goods and services. There's a supply side issue with inflation as a concern. But I think the drag from fiscal, the drag from higher fuel prices, which is almost like a tax, and many other factors suggest that demand will weaken in the second half going into next year. An outcome of a rapid Fed rate increase has been a very strong dollar. And that strength shown in this DXY index is quite dramatic. And it's we're at multi-decade highs. The Asian dollar index has fallen quite a bit. And we've seen that effect of that even here in Singapore moving to 1.4. But Singapore dollar has actually outperformed most of the Asian currencies and emerging market currencies. What that implies is that liquidity is being withdrawn, not in the US necessarily, but overseas, especially in emerging markets, which is a very negative thing. So what's happening is that growth everywhere is slowing down. It's not just a US phenomenon. The global GDP forecasts are continuing to be revised down. The World Bank has done it. IMF has done it overnight again. And growth is significantly lower than what it was expected. The other fallout of a very strong dollar and the reduction of dollar liquidity in global markets is that the emerging markets are suffering. So the right side shows the energy and food price CPI. Ridiculous numbers in India. Food CPI is at above 50%, but energy also has been dragging that higher, and also is resulting in dollar liquidity. The food and energy shortage is resulting in a lot of unrest internally, but also politically, socially, and human tragedy wise as well. But what it also does is it really damages the sovereign bonds' ability to continue to, pay the interest rate on their bonds that's outstanding. And the dollar FX move, many of these EM currencies have blown out and have moved 20, 30, 50%, let alone Russia, which has moved more. But, if you move 30, 50%, that's a 30, 50% cost increase in the servicing cost of debt. And so the number of distressed EM sovereigns has increased quite dramatically. And as a result, a lot of countries are having to defend their currency by raising interest rates quite significantly to stem the outflow of capital and to make themselves more defensible. Because with the lower FX rate, with rising food and energy prices, they can't buy as much, and they're having to pay more on interest payments on their sovereign debt. It's a very, very negative thing for emerging markets. And so emerging markets continues to be a concern, but the bulk of emerging markets, especially in Asia, looks okay. It's some parts of Asia like Sri Lanka and now Pakistan, but some parts of Eastern Europe and also Latin America are a concern. Moving on to China, which is an emerging market, but it's a huge market of its own. Obviously, with the COVID lockdown and supply chain risk, growth is a problem. Everyone's watching the government to see whether they revise down their target. But what's positive is that the government is talking up growth again. They're relaxing certain regulations. They're fiscal pump priming. They're lowering interest rates and reserve ratios. And so they are making an effort. But despite that, we've seen a massive increase in corporate bond effective yield, and that higher borrowing cost is hitting the risky areas of China, where there are certain parts of real estate and other highly leveraged segments of the economy. This is adding a significant burden and potential risk. So what's happening is that actually the equities portion, as Min presented earlier, is actually defensive. Valuations are cheaper. It's a value play, and therefore have outperformed a little bit. Whereas fixed income continues to be a little bit more challenging, and there's continuing discussions and doubt about the sustainability and also the risk associated with the highly indebted sectors. Now, one positive and silver lining is that inflation is a year-on-year number. It's a change number, and if you look at the various factors that provide input into that final inflation number, whether it's on the supply side, whether it's on the manufacturing input cost side, or whether it's the demand side, all of it is coming off, and supply is coming off. Input costs are starting to roll over a little bit. And demand has certainly come off quite meaningfully, and therefore there is expectations or hope. There's still hope, I think, that potentially inflation may be peaking. And we've seen other PMI data on multiple cost factors, whether it's labor, energy, or materials, starting to show numbers that inflation may be peaking. And if inflation starts peaking, then I think the market will respond very positively. The other positive is that valuations are down quite meaningfully, especially in equities. You can see that the current valuation is meaningfully below the long-term averages for pretty much every single market. China, after the rebound, maybe a little bit less, hasn't fallen as much, but Europe and Japan significantly below, and even US has finally come below the long-term averages. And one of the reasons is because the earnings has been relatively robust. Earnings numbers are not that bad. 10% growth this year, 9% next year expectation, and then a stronger recovery into 2024. But China obviously dampens the numbers for earnings this year, and we'll see a significant rebound. So that valuation will start to come down quite dramatically. And so I think from a valuation perspective and from an earnings perspective, it's not an earnings recession yet, and therefore that's something that is the market will keep positive. And fixed income is actually even more attractive from a valuation perspective, because if the yields have blown out, the spreads have blown out, and therefore compared to the 10-year range and the mean, the current yield spreads are at the highest level for most products, other than the high yield, which has continued to hold up better. But for example, emerging market debt, euro, US dollar, and also investment grade corporate bonds. There's some in the US, like US Treasuries and munis and ABSs, mortgage-backed securities, which will be impacted by the Fed starting to unwind their balance sheet, starting to sell, and therefore they may not narrow the spread as fast. But investment grade corporate sector and emerging markets and high yield may be areas where for fixed income it may not look too bad. Now, I do want to address and close by addressing this question of what happens to markets during recessions, because everybody's worried about recession. So this is a list of all the recessions, 12 of them in the US, official recessions that were announced, various durations, normally lasting about 12 months, but can last almost 1.5 years before, contraction in GDP. But the equity market returns before, during, and after is very interesting. And I just put this into a chart form. The average return for the S&P 500, 6 months before the recession, 3 months before the recession, and actually during that 12 or 18 months period of recession or shorter, have been largely flat. So the markets in that period over 12 months or 18 months is not losing a lot of money. Sometimes it's up, sometimes it's down, but largely flat. But what happens after the recession, obviously, is that the market starts bouncing back. and over 1, 3, 5 years, it does really well. But there is a period during that period, sometimes before the recession, sometimes during the recession, or sometimes after the recession, where the market falls a lot. And we call that a peak to trough fall, a maximum drawdown. And that, on average, is about 30%. So the markets fall at some point before, during, or after recession, peak to trough of 30%. But actually, if you just slept through 3 months before the recession and woke up after the recession, then you wouldn't know this would have even happened, because this is all you would see. So it really is important to understand that, being actively trading in the markets during volatility, during a market downturn, is not an efficient way to manage your long-term portfolios as you would with Endowus. And so it really is important for you to understand that, like, trying to time the market is almost an impossible thing to do. You're not smarter than the market. And also, you will miss the best performing market days, because the best performing market days are rebounds after significant falls in markets. So in order to time that market and pick that bottom and remain be invested at the bottom, the only way to be invested at the bottom is to be invested throughout the cycle, so that you invest and you are invested when it's going down, and then you continue to invest on the way up. And one of the best ways to exercise this is to have a regular savings plan, whether it's a monthly or quarterly, where you deploy your savings and continue to dollar cost average during a downturn. And so if you missed the best week of a 50-year period, then your return would be down quite meaningfully. And if you just miss a few months, then your returns get reduced dramatically, because some of the best performing days are during a downturn. So we need to remain invested and not try to outsmart the market. And we have to manage our emotions as investors, because the point of maximum opportunity is when everybody is frustrated and angry and markets are down. And as a long-term investor, if it's wine or a car or whatever it is, an important asset that you'll eventually buy anyway, a house, if the price goes down, then you get excited because you can buy it cheaper. But in financial markets, for some reason, people get, and some of it's because we already own a car and the price has gone down and the resale value has gone down. So asset prices going down and we own it, it hurts us. But I think that we have to understand that there is a cycle, that at the point of maximum discouragement is the point of maximum opportunity as an investor. And we have to stay disciplined. And as long-term investors, we know that a regular, disciplined way of approaching investing is the right way to do that. So with that, I'm going to move over to Q&A. But before I do want to highlight this wonderful webinar next Thursday. So Min will be leading that one, and I'll be taking a back seat. But we have an amazing, speaker from Amundi, who's the Chief Responsible Officer, and also Mervyn, who's the Head of Sustainability Strategy at Schroders, two of our amazing partners, and some of the largest global fund managers on ESG investing. Is it hot air or here to stay? Min will answer that question with our speakers next Thursday. So please dial in. But we will answer a few Q&A before we go. But I do understand that we're past the hour. Sorry, I did go on a little bit longer on market outlook, but I did want to go into a bit more detail to help our listeners understand a little bit better, because we have the wide range of beginners and more sophisticated investors. So please bear with us as we try to meet the needs of all of our clients and our guests today. So I think we've answered, and our client advisory team and investment office team have also been answering some of these questions. Min, if you have any that comes out that stand out for you that you want to answer, you can jump in at any time.
Yeah, I mean, there were a few questions on recession, but I think your presentation addressed them already. It's just how investments will perform when in a recession.
Yeah, okay. Yeah, recession is coming with fixed income rise. So that's the interesting thing, that if you look at the data, and I didn't have it here, I had it in a previous presentation, is that actually during the recession period, fixed income should be positive, right? And so historically, there has never been a negative period during a recession, negative return period for fixed income during a recession. But things have changed. We've had a long period of falling interest rates. We've had massive Fed balance sheet expansion and quantitative easing, and so the environment is different. But what 2020, maybe in a microcosm, can give you an understanding of what happened and what could happen this time, is that March 2020 fixed income fell, and equities started falling, and equities dramatically fell. Fixed income fell very quickly, but rebounded much faster. And that was because the global liquidity was squeezed, the US dollar strengthened. So many of the things that we're seeing right now is playing out in slow motion in an extended fashion versus what happened in March of 2020. So I am pretty confident that at a certain point, fixed income will rebound. I'm pretty confident that fixed income returns will turn positive incrementally, not reduce all of that negative return. But what we need is a few things. One is that we need time for fixed income products to mature and recycle into higher yield that would generate the returns. But we also need interest rates to start, not rising anymore. So the headwind of rising interest rates has to stop, and we'll really start outperforming when interest rates start falling. So that's something that we may be able to expect next year. But I think interest rates have reached a peak in terms of market interest rates, despite Fed continuing to increase, and therefore fixed income is something that I think we should not be selling, but we should be looking at to deploy additional capital or start buying. And I think there was some questions about well, there's one question about Europe. Again, we don't know what the future holds for Europe, what the future holds for Ukraine and Russia. Things changed dramatically. It looked like Russia was making advances and really damaging Ukraine infrastructure and stuff. And then they suddenly said that they're going to have a ceasefire for grain exports. So the inventory of grain in Ukraine that will eventually go bad, they have a window to export it. So 20% of the global demand may be coming out into the global markets and easing the price for soft commodities and food. And so that there was hope there, and then maybe Russia will break that, and then we'll be disappointed. Or because of the long-range missiles that Ukraine just received, they can actually counter Russia and push them back, and things may change again. So we don't know, and we don't know the intentions of Putin, because he's managing the European energy supply and gas supply. They said 40%; it's dropped to 20% now. And that's something that Russia can willy-nilly and at Putin's discretion do. But what is definitely clear is that Europe will suffer an energy crunch, especially going into winter. They're trying to ration that and have a cap in pricing, cap in terms of demand. But we don't know exactly how that will play out. And Europe is most likely to see at some point a recession as a result of Ukraine, or result of the energy issues. That's why I think European currencies have weakened, and also markets have been relatively poor. So from a relative perspective, I think generally Europe is something that with the uncertainty, we shouldn't be too bullish on at this point in time. There's a lot of questions about rebalancing as a result of the Amundi funds. We are rebalancing the flagship portfolios and any portfolios that will have the passive component to it. So please look out for that. And we'll have recommended portfolio changes for our portfolios in flagship. We will also, look to do any rebalancing that will improve the risk-adjusted returns of our portfolios. Or we find better substitute underlying funds which are lower cost like the Amundi funds or other passive index funds that will come. So we'll continue to enhance the portfolios, but we will not make tactical decisions, trying to beat the market or trying to play the market or trade the market. That's not something that Endowus portfolios, advice portfolios, are made for. But we do have the FundSmart platform so that if you want to asset allocate, you can consult with our client advisors and also deploy investments into these funds. But with that, I think that we've run out of time. We will continue to respond to the questions that we were unable to answer. But I hope that was helpful to everybody and really grateful for everybody for joining another long session. And I'm going to end with another plug for the webinar next Thursday at 7 p.m. Same time, but not Wednesday, Thursday. And Min, our Director of Investment Research, will be joined by Yasunori from Amundi and Mervyn from Schroders to discuss whether ESG is really here to stay, whether we should be deploying new money to it, or whether it's all hot air and we need to worry about the future of ESG investing. So Min, anything you want to add or say before we say goodbye?
It's going to be a really interesting discussion, with Amundi and Schroders. They're really knowledgeable about ESG, and they are very right at the forefront in ESG investing. So very excited to have that discussion.
Great. Thank you so much, everybody, for joining us, and have a wonderful evening.
Thank you, everyone. Good night.
Thank you.